everyone, I'm Karunya Rao, and if you remember, Radico Khaitan has been our high conviction bet from the alcoholic beverages space. The company continued to surprise positively as it once again delivered record sales in Q4 FY21. With the stock making fresh all-time highs after a strong set of earnings, should investors keep holding or look to sell into the rallies? Let's find out in today's edition of Ideas for Profit. Well, if you talk about the Q4 performance, Radico delivered the highest ever quarterly sales, led by a 7% year-on-year growth in overall business volumes. While sales volume of the premium segment, which is prestige and above segment, rose 15%, volumes in the popular segment grew 5% from a low base of last year. Gross margins at 48.4% were down 140 basis points YOY due to some inflationary pressures. But on the other hand, you had operating margins which benefited from strategic cost-saving initiatives. Steep reduction in net debt resulted in interest cost savings and boosted the bottom line performance. During Q4, advertising and sales promotion spends increased by 52% as the company continued to strengthen its global presence with brand building initiatives. The performance of luxury brands, the likes of Rampur Indian Single Malt, Jaisalmer Indian Craft Gin, was quite encouraging owing to expansion in distribution network across newer markets. If you look at 8PM Premium Black Whiskey, that also clocked sales volumes of over 1 million cases during the last fiscal. The product pipeline is looking extremely healthy as the company intends to launch more brands in the premium brown spirit space over the next 12 to 18 months. Radico's gross margins have been largely stable as the prices of major raw materials have been benign due to normal monsoon. However, the recent changes in ethanol policy could result in inflationary cost pressures which would be difficult to offset through product premiumization. Moreover, the commodities basket, oil, metals, agri and so on have also seen significant upmove in the last few months. So towards the end of FY21, the company witnessed some inflationary pressure on dry goods such as packing material. There was a spike in crude oil prices as well, which could accentuate the pressure on the margins front going forward. Radico has generated positive cash flows from operations and free cash flow at an average rate of 250 to 300 crores over the last 4 to 5 years. With about 184 crores of debt repayment in FY21, the company has reduced its outstanding debt by 750 crores in the last 4 years. And at the end of the March quarter, the balance sheet had an outstanding debt of close to 200 crores. For FY22, the maintenance capex and some brand-related capex is expected to be in the range of 70 to 80 crores, and therefore free cash flow could help Radico achieve debt-free status by FY23. Radico's long runway of growth in the domestic market is driven by favorable demographics and premiumization trends. If you look at the stock, it has started witnessing a re-rating once again as the management continues to execute well and the long-term outlook also appears promising. Following the strong share price performance in the recent weeks, Radico's stock has gotten re-rated to 33 times of FY23 earnings. The most obvious question here is whether this is a one-step re-rating which has run its course or whether there's more gas in the tank. While fresh capital allocations are not advised at current levels, existing investors should continue to hold the stock as we believe the stock has more room to grow given the secular industry tailwinds that will drive further earnings growth. However, some risks to watch out for would be weakness in the overall consumption space and adverse regulatory changes such as hike in excise duty, which remain key monitorables for investors to watch out for.